Hello and welcome to Moneycontrol. You're currently tuned into the IPO Watch, and I'm your host Nikki Mirchandani. Today we're going to be talking about Jupiter Lifeline Hospitals, the multi-speciality hospital planning to raise around 869 crore, coming up with an IPO on September 6th. The fresh issue consists of 73 lakh equity shares, aggregating to over 542 crore, and an OFS of another 327 crore. The proceeds from the issue, worth around 510 crore, will go towards debt repayment. As of March 2023, total debt of the company stood around 476 crore. But to talk us through the company's profile, strategy, financials, we've been joined by Dr. Ankit Thakkar, CEO of Jupiter Lifelines Hospitals. Hello there.
Hi, Nikki.
All right, I'm going to start off by asking you about your strategy first. That is the all hub, no spoke model. How different is it as compared to the other models that we have in the hospitality business? What's the USP? And tell us more about the company.
So, yes, you observed that right. We have a all hub strategy. What that means is that we have chosen not to grow with small spoke hospitals centered around the flagship, and we have taken a conscious call that each hospital that we build should be of full size, scale and scope, and there should be no service which would not be provided in that hospital, because we believe that the two key stakeholders in a hospital are clearly the first being the patient and second being your financial investor. The interest of both the patient and the financial investor in this case align and coincide in a hub model, because if you are at a larger flagship hospital, intuitively you understand that it would have all the doctors, it would have all the specialties, all the technology, and it would really take care of the patient well. And similarly, economies of scale are always achieved at a size, and for that reason we like this hub model of expansion.
Sure. So tell us more about the hospital. You operate in you have three facilities. You're coming up with the fourth one, if I'm not wrong. Talk about what all services do you offer, inpatient treatment, everything that you have on board.
So yes, we currently run three hospitals. The first we built was in Thane, the second we did in Pune, and the third one in Indore. Currently we have started construction on a 500 bed hospital in Dombivli, which is in Mumbai metropolitan region. All the hospitals in terms of services would be similar. That is, we would do everything starting from childbirth, going right up to organ transplants, cancer, spine surgeries, open hearts, etc. So, we are fully comprehensive healthcare service providers in all the facilities, and all of them will function as flagship hospitals.
All right, you cater to over 30 specialties, right? So could you tell us more about those core specialties? Are you focusing on something, or do you intend to be diversified? How are you looking at it?
So, all the locations where we are present, we are pretty much the dominant healthcare service provider in that region, and typically in a half an hour driving distance from where we are located, there are 1 million plus people who would rely upon us for their health care needs. So, a size of population that large needs all kind of facilities. There is it cannot really be concentrated on one, two or few branches, and we believe in serving all the needs of the communities where we operate, and for that reason we have decided that we don't want to specialize in a few branches, but we would like to excel in all the branches.
Currently, you're located in 3 locations, coming up with fourth. I wanted to understand how else do you intend to geographically diversify what's on board for the company, and B, why there is no significant presence in the key metro cities? What's the strategy there? How does the company intend to go along with that?
We have identified Western India as our canvas for growth,
right,
and we would, even for the next phase of expansion, want to focus on Western India, because we believe that there is a huge white space and a huge gap between demand and supply. Most of the organized players in healthcare are north or south centered, and very little good quality healthcare is generally available in the west. So that is the canvas where we have chosen to operate, and the next growth will also be within this region. And as I was just saying sometime earlier about the micro market characteristics, that is, in areas which are densely residentially populated and relatively underserved in terms of tertiary quaternary healthcare, those are the areas we would like to focus on.
So essentially, you said Western area is where you have placed your focus on. Have you identified land parcels there? How is the situation stacking up? Could you provide us with more details, and also why invest the money or raise the money for repayment of debt against going for expansion? What's the strategy there? Talk about that.
Absolutely. So we have not really signed on new lands yet, but we are thinking about and exploring few geographies in Western India currently. You kind of hit the nail on the head that it does not make sense to issue fresh equity just to become debt free, but because we believe that for our company the choice of growth strategy is going to be greenfield expansion, that is, we would like to buy the land, design and build the building and then operate it. There is no way to deploy all the capital on day one. So for that reason, we think that the most efficient use of capital now is to pay off all the debt, and as a consequence of that, we would have more free cash available year on year in our hands because of savings due on account of interest and principal repayments, and that money would then be used to plow back and grow the company.
Is it also because that your debt to equity ratio seems to be a little bit on the higher side as compared to that of the industry standards, almost 1.3 times as compared to 0.6 times that of the industry? Is that also one of the plans because of which you're raising in capital also so that you could be a debt free company?
So as a general rule of thumb, we like to be more intrinsically focused than extrinsically focused. So our debt profile at the current time is not really making us very uncomfortable. Debt to EBITDA levels are also 1:2, 2.5 range. So to our minds, I don't think we are aggressively leveraged, but for the reasons I spoke about earlier, that is, I believe that the best use of capital for us in case of a greenfield expansion where money is not required on day one to acquire something, it is required in a staggered manner month on month on month. This kind of extra free cash which we will generate because of a debt free status will help us deploy capital more efficiently and grow.
All right, let's also talk about your fresh issue size being cut from 615 crore to a number of 542 crore currently. What explains that?
So the explanation is that couple of weeks back we raised 123 crores in a pre-IPO round in which some institutional investors participated, including SBI Mutual Fund, Neuberger Berman, White Oak, etc. So we have raised 123 crores already, and for that reason the IPO size is now a little lower.
Okay. Also, let's talk about your financials. In that case, revenue was increased almost 50% in FY21. If you talk about FY22, the growth seems to have tapered down to 21.75%. What explains the slower growth that you've seen in FY22, and at the peak rate potential, what revenue projection can you look at?
So FY21 was the COVID year, and in that year we had reduced revenues, reduced EBITDA numbers, and that was a conscious call which we took. We thought that that was a year of humanitarian crisis, and we thought that was a time to really stand by the community. So we actually increased our costs and lowered our revenue. We decided to do zero layoffs, we decided to do zero pay cuts. On the contrary, we compensated our team a little better. And on the revenue side also, whatever soft guidances were issued by the government to support on pricing, we followed those. We supported the community in terms of subsidized COVID drugs, vaccination, etc. So there were a lot of things which contributed in a below par financial performance in FY21, and because of the lower base, the growth in FY22 looks much more stark. But on an absolute level and on the capacity utilization level, we are satisfied with the FY23 numbers as they stand now. Going forward, to answer your question, the growth going forward we see predominantly coming from Pune and Indore hospitals, because they still have headroom to utilize more of the capacity in terms of better occupancy numbers for the next couple of years, and after that Dombivli will kick in, get operational and start contributing, and meanwhile whatever are the new projects we identify, eventually those should take over.
So 892 crore is the FY23 number. On the peak rate potential, I'm not asking you to give any projection on the peak rate potential. How scalable is your revenue?
So the Thane property is occupying around 72% of the capacity as of last year. We believe anything between 75 and 80% as a peak can be achieved. Expecting more than that on a sustained basis in our view is not realistic. However, Pune and Indore have a road ahead of itself. After the new capacity addition in Pune, we are at just mid 50% occupancy. So Pune did 300 crores last year at 50 odd percent occupancy. That can grow by 50% from here in terms of occupancy use and translating into revenue numbers. Indore did 40% of 230 beds and gave a revenue of 100 crores. Going forward, that will get ramped up, and we have an opportunity to add 200 more brownfield beds in Indore. So significant opportunity in Indore, which is just getting started, and Pune, as I explained earlier.
Okay, so could you reiterate your occupancy rate for 3 facilities from where it is to what you expect in the next financial year? And also, if you could give a growth figure of how scalable directly without doing the back-end calculation upfront out there, what is the revenue projections, scalability at the peak that one can expect?
So revenue projections is hard to make at this point in time.
Sure.
However,
so let's talk about the occupancy in that later.
Yeah. So the occupancy, Thane did 72%.
Okay.
Pune, we are at mid 50% occupancy, and Indore was 40% of a lower base of 230.
Okay. And how much does that intend to increase? At least for Indore, you expect to go to?
So we expect that properties mature between 75 and 80%.
Okay, all right. And the one for Thane?
Similar. So all three will go there.
So 75 to 80%. Okay.
In this model, because each hospital has a finite capacity, there is a finite capacity of growth. So for the life cycle of the company, the sustained growth will have to come from newer hospitals and newer properties. And the mature hospitals' role will be to generate cash and fund the new capex.
All right. Okay, revenue CAGR or just the operating CAGR, operating income CAGR from FY21 to 23 is at 35% in line with the industry standards. What can help you outperform? That is one. And also I wanted to bring in the aspect of your consultant doctor attrition falling from 5% in 2022 to 1.85%. What is the strategy behind that? What is aiding this attrition rate? A. And how do you intend to outperform the industry standards thus far?
So on the attrition side, we have always done very well in terms of doctor attrition.
Visible enough.
We have been able to develop a culture of a conducive work atmosphere, not just in Thane but also in the other 2 hospitals which we started subsequently, because of which our doctors have rarely decided to part ways and step outside. So that has been a kind of sustained phenomenon over the years. In terms of your second question, I think was about the growth keeping up.
Correct. How do you intend to outperform the industry standards?
Again, I think the story that we have told all the institutional investors also, and I will tell you which resonates with our thought process, is that our job is to do our job well. And while of course the investor community has to judge peers to make investment decisions.
Right.
But as an operator, I would only do injustice to the investor community if my focus was on what my neighbor is doing rather than
It's
what
just
I'm
being a little more, shareholder friendly, because there are listed entities already running in this space. So the only differential factor for your company with them could be you being an outlier in certain
Correct.
specific area.
Correct.
All that we're trying to understand is what is your USP here, and how do you intend to beat the margins clocked by the listed entities, so that the company, so the shareholders can lap up your, investors can lap up your shares.
Sure. So I understand what you're saying, and for that reason, what are the things which we do in order to generate, good financial outcomes, which would eventually help the investor community.
Right.
So we run extremely tight operational ship. Our procurement costs are, probably amongst the best in the industry. Our recovery cycles and account receivable numbers are extremely strong. In terms of attrition, like you noticed, we are very, very sticky culture, which eventually helps us to deliver good care to our patients, which will eventually drive everything else. So these are some things which we would focus on. On other things for financial outcomes, we believe that it is a consequence of a lot of decisions that you take as a part of your business strategy. So in a greenfield strategy, if we allocate our capital sensibly, that is the entry cost of a new hospital is efficiently planned, if the construction and technology costs are managed, if the operating costs, which I spoke about some time earlier, we are able to keep in check, and finally, of course, the patients get good service. Consequence of all of that is the financial outcome, and in our mature hospitals, we have been able to create upwards of 25% of EBITDA margins. So we believe that by focusing on the right things, that is taking multiple decisions correct on a day-to-day basis, we are able to generate these results.
I also wanted to understand, since you said that you intend to expand in Western India, and probably you've also identified few regions for your expansions. So how many more facilities are you planning within that area? How much do you intend the count to be by the end of, say, FY24 or FY25?
So in FY24 or 25, no new facility will come. The first new facility, that is Dombivli, is expected to probably come in FY26, because we have just started constructing, so it will take 2 to 3 years to build a 500-bed hospital. Besides that, our objective is in the next 5 years to go somewhere between 2 and 3,000 beds in Western India. So doing the math, it would mean maybe 2 or 3 more hospitals, which we would have to do over the next few years.
And you say next few years, 2 or 3 hospitals, in how many years that you anticipate?
So in 5 years, we want to be between 2 and 3,000 beds.
Okay.
And with Dombivli, we'll be at 1,700 beds, 1,200 now and 500 more of Dombivli.
Okay.
So maybe if you just look at a midpoint of 2 and 3,000 would be 2,500 beds. So 800 more beds could probably mean 2 more hospitals.
Okay. Okay, that's the plan for the next 5 years.
Correct.
In that case. In terms of occupancy, since we are at it and we're talking about it, how sustainable is the company's profitability, given that the bed occupancy rate right now is lower than that of the majority of the listed payers? For Jupiter, it is at 63%, and if you look at the other hospital business, it's roughly around the range of 65 to 75 odd %. So what explains that?
So it is the life cycle of the hospitals.
Okay.
What we do is we build the whole hospital as a shell on day one, and then we start ramping up the capacity as it gets utilized. So Thane has walked that entire journey, and now it is fully operational, and it has 72-73% occupancy.
Okay.
Pune at the end of last year had 67 odd % of occupancy. That we thought was a good time to take in further brownfield expansion, which we have done recently. So now of the expanded base, Pune has a lower percentage occupancy, which is good because it allows us a headroom for growth. Similarly, Indore, it is designed for 430 beds, but currently we are only operating 230. So we have 40 odd % occupancy at the end of last year. This year we are already seeing a growth. So once we reach 60 odd % of occupancy of 230, we'll start adding beds here also. So purely a percentage occupancy would not always tell a whole story because of the way we expand.
Sure. So do you at any given point of time, to match up the number, though you're not looking at your industry situation, would want to offer more discounts perhaps to lap up or to increase the occupancy rate, if that's one way to look at it also?
Honestly, pricing power is usually market related in relatively competitive industries. I don't have an illusion of having the entire pricing power vesting within my control. It is a factor of multiple things. It is a factor of the city in which you operate. It is a factor of who are the other peers operating in that city and what are the pricing by them. It is a factor of the insurance company reimbursements. So I think that the pricing that we have is fair in market terms, and I don't really see a great merit in I don't know, for the lack of a better example, going the e-commerce way for healthcare.
That's a point well taken, but we're just going to wrap it at that, and thank you for taking out the time and speaking to us and the viewers and explaining in detail about your business model.
Thank you. Thank you for having me, Nikki.
All right, pleasure. Well, with this, it's a wrap, and goodbye from Dr. Ankit and me. Thank you so much for watching. Please do post your feedback for us in the comment section below. Follow us on the link at the bottom of your screen, and for rest of the updates, stay tuned into moneycontrol.com and Moneycontrol app.